We're looking at a rally as a fragile ceasefire holds. 30 minutes until the start of trading. I'm Matt Miller.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, it's risk on for markets as traders continue parsing through rapidly changing headlines out of the Middle East. President Trump trying to force a ceasefire as both Israel and Iran accuse each other of lobbing bombs, and Treasuries hold steady after Chair Powell says the Fed is well positioned to wait. Katie, what are you looking at in terms of the cross-asset board?
Let's take a look at the ripple effects right now. You can see the S&P 500. Matt mentioned that big rally that we saw yesterday, up nearly 1%. It's continuing today, up 0.7%. Brent crude, just a wipeout underway. Brent crude down 3.6%. We're back below $70 a barrel as that fragile truce, that ceasefire, seems like oil traders believe it will last. And the bond market, perfectly unchanged almost when it comes to that 10-year Treasury yield. We are a hair below 4.35 right now. It'll be interesting to see that line, whether or not it moves once Jerome Powell starts speaking.
I think it is so fascinating that oil traders believe this rally of this ceasefire, of which we are so skeptical. Take a look at how that's working its way into stocks right now. I'm watching the same energy, defense, and airline stocks that we were looking at yesterday, but the picture is reversed. ExxonMobil now down. As Katie showed you, Brent crude, it's gone from over 80 on Sunday night to below 70 today. Lockheed Martin down 1.2% as the fragile ceasefire holds, or I guess you could say it isn't holding if they're still shooting rockets at each other. American Airlines Group actually rising more than 2%. So it's really a reverse picture of what we saw yesterday morning. But of course, in yesterday's trade, we saw this all turn around, Katie, and we're now close again to record highs on the stock market.
Well, on the topic of that fragile truth, President Donald Trump says that both Israel and Iran breached that ceasefire, but there will be no consequences. He spoke on his way to the NATO summit in the Netherlands.
Israel, as soon as we made the deal, they came out and they dropped a load of bombs, the likes of which I've never seen before. The biggest load that we've seen. I'm not happy with Israel. You know, when I say, okay, now you have 12 hours, you don't go out in the first hour and just drop everything you have on them. So I'm not happy with them. I'm not happy with Iran either. But I'm really unhappy if Israel's going out this morning because the one rocket that didn't land, that was shot, perhaps by mistake, that didn't land. I'm not happy about that.
President is in the Netherlands for the NATO summit, and so is Bloomberg's chief political correspondent, Anne-Marie Hordern. Anne-Marie, what do we hear, especially from our allies, about this ceasefire with which they had nothing to do?
Well, the president is certainly going to be met with two different viewpoints here in Europe. You have France's Emmanuel Macron coming out and saying he thinks the U.S. strikes on Iran were illegal, even though he does believe and agrees with the United States that Iran should never have a nuclear weapon. And then you have the new German chancellor who said that what Israel did was, quote, the dirty work when it comes to the strikes on Iran, and basically saying, why should we in Germany criticize Israel or the U.S. for these strikes? So those are going to be two of the different viewpoints the president is met with. We should note, as the president is making his way here to The Hague from Washington, D.C., briefing reporters very early this morning, he seems incredibly frustrated, so much that he used an expletive when he was talking about the fact that he does not think that these two countries, Iran and Israel, have been fighting for so long and so hard, know what they're doing. He did tweet, though, that Israel will not be sending more strikes. He is trying to make sure that this ceasefire that is very fragile stays put. But that is why this conflict in the region is really going to overshadow the summit, because it is vulnerable, this ceasefire, and there's a lot of concern that potentially this could still be met with more tit-for-tat missiles between these two countries in potentially weeks to come, even if this is the start of the end of what we've seen play out over the course of the last nearly 2 weeks.
I want to meditate a little bit more on that frustration that we've seen from President Donald Trump, because he also is publicly frustrated with Israel as well. Of course, as you mentioned, he's since tweeted that, tensions will cool, at least when it comes to Israel's side. We also heard from the PM office over there saying that Israel will abstain from further strikes. But it's not often that we see Donald Trump publicly express frustration with Israel to this degree.
Yes, he's frustrated with Israel, and I believe this would stem from the fact that Israel said that Iran breached the ceasefire. So the Israeli Defense Minister, Israel Katz, came out and said the IDF will now retaliate. And what Trump was saying there is that he doesn't want to see that retaliation, and he wants their planes to come back home. But this was an interesting dialogue from the president this morning, because he wasn't just lashing out at the Iranian regime, he was also lashing out over what is going on in Israel, blaming both of these countries to be in breach of the ceasefire that he really forced together over the course of the past 24 hours.
All right, Bloomberg's Anne-Marie Hordern, appreciate your on-the-ground reporting from The Hague. Let's stick with the fragile tensions in the Middle East, because joining us now from Geneva is Dina Esfandaria. She leads our Middle East coverage for Bloomberg Economics. And Dina, I actually want to start with Brent here, because we looked at Brent prices this morning, down about 3.6%. We're well below $70 a barrel. And as you can see on that chart, we're really at the levels that we were at even before we saw the initial strikes. Matt and I were talking about how it seems like oil traders are seeming to be voting with their feet, that they think that this truce will hold. But is that your read when you take a look at that chart?
I mean, that's exactly it. It looks like traders have decided that this conflict is over, or at least the worst of it is over. And I think to a certain extent, they're probably right. The ceasefire does appear to be on shaky grounds, but I think that we're going to see this become our new normal. Israel and Iran have been at each other's throats intensively for the last 12 days, but also over the last few years. I don't think those tensions are going to go anywhere just because President Trump pulled a ceasefire.
What happens next, Dina? I mean, do you expect this truce to actually hold, and do we then move to talks?
Well, that's the million-dollar question now. I think what happens next depends a lot on President Trump's relationship with Prime Minister Netanyahu. He has asked the Israelis to respect the ceasefire, as he has asked the Iranians to respect the ceasefire. The question is, will they? I think that what we're likely to see is a kind of low-level confrontation, low-level shooting at each other like we haven't seen yet, but much less than what we've seen over the course of the last 12 days. Alongside that, I suspect we're likely to see a return to some kind of negotiations with Iran on its nuclear program. The question is, even if Iran returns to the negotiating table, is it really going to accept concessions on its nuclear program after this war?
So we're so focused on supply here, especially worried about the closing of the Strait of Hormuz. It looks like that may not happen. But what about the demand side of the picture? I mean, the price, as Katie pointed out, has been low even before this confrontation. So is demand globally weak?
I think it's just changed. I think, as you've pointed out, the supply side has really made up for, at this changing geopolitical situation, the changing environment that we find ourselves in. It looks like the price is already building in the risk, the geopolitical risk. It looks like it's relatively stable. It's almost isolated from what's happening geopolitically in the region. I suspect that given what we saw over the course of the last week or 10 days, if despite such open confrontation, prices have remained somewhat stable, I think that what comes next, which is likely to be slightly more stable than what we've seen over the course of the last 10 days, I think we're going to see stable oil prices no matter what.
All right, Dina, great to get your insight. That is Dina Esfandiari from Bloomberg Economics. Let's turn to the Federal Reserve, because Federal Reserve Chair Jerome Powell says that the U.S. economy and labor market are in good position and is in no rush to cut interest rates, saying he needs more clarity on tariffs. We've certainly heard that one before. And President Donald Trump hopes that lawmakers can intimidate Powell into cutting rates and says that the Fed board should, quote, activate. For more on what to expect today from Jerome Powell, we are joined now by Michael McKee. He is Bloomberg's international economics and policy correspondent. Interesting to get these headlines from Jerome Powell ahead of his remarks later today in the 10 a.m. hour, because in the past couple days, we've heard two Fed members come out and say that maybe July is on the table. It seems like the top dog here is saying not so fast.
He's definitely pushing back on it at this point, Katie. He doesn't seem to think that there's any hope for a July rate cut, although most of what he says, almost word for word, this is the same as his statement to the press at the top of his news conference last week. Nothing really new in it. The outlook for the Fed depends on what Donald Trump does, although he doesn't mention him by name. But in the testimony, he says policy changes continue to evolve and their effects on the economy remain uncertain. Increases in tariffs this year are likely to push up prices and weigh on economic activity. The effects on inflation could be short-lived, reflecting a one-time shift in the price level. It's also possible that inflationary effects could instead be more persistent. So he says that basically we need to know what the tariffs are, when they go on, and how long they're going to last before we can make a decision. He goes on to say, for the time being, as you mentioned, Katie, we are well positioned to wait to learn more about the likely course of the economy before considering any adjustments to our policy stance. Now, as to those comments from Chris Waller and Mickey Bowman, you look at the calendar and you don't see much support for what they're talking about coming up. We have jobs on July 3rd, and then we have the reciprocal tariffs coming out on July 9th. The next time we get PCE inflation after this Friday is the day after the next Fed meeting. So we'll have one inflation indicator, CPI, on July 15th that would have to do all the work for Waller and Bowman. We'll see if they can get that much out of it, but it doesn't look like the rest of the Open Market Committee is ready to join along.
Mike, the president is urging lawmakers to grill Powell. He wants them to try and intimidate Powell into cutting rates. What is the point of the bullying of the Fed chair if he clearly isn't going to bend?
Well, there are some people who think that the pressure does work. They point to Waller and Bowman and suggest that since they are Trump appointees, they might be reflecting some of the pressure. I don't think that's necessarily the case, but it is a possibility, I suppose. And they're hoping that maybe enough pressure from members of Congress will tell the Fed president that he doesn't need to wait, that they can go ahead and cut rates and make up for it later. As you say, Matt, I don't think that Jay Powell is going to listen.
Mike, thanks very much. Bloomberg's Michael McKee there in Washington. And we'll obviously bring you that Fed testimony live as it happens, starting at 10 o'clock. Let's check out some more of the movers on our radar as we count down to the opening bell. KB Home cutting its full-year housing revenue forecast. You can see the stock there down 2 2/3%. And I think it's more interesting to see this move, Katie, in a down market, right? Because this is one of those tides that's going to lift pretty much all boats.
You mean an up market?
Sorry, an up market. Yeah. Except KB Home, obviously down.
Yeah, absolutely. They cited market conditions for the home building sector softening. We know that the housing market has been in a really weird place. Let's talk about Uber, though. Uber will begin offering driverless Waymo rides in Atlanta. You can see that's boosting shares to the tune of 3% pre-market. Interesting to see this announcement, of course, on the heels of this weekend's robo-taxi launch, which boosted Tesla shares quite mightily yesterday.
Right. I actually got a Waymo in Austin using Uber. So they offer this service in other cities, and it works pretty seamlessly. Lyft also getting a lift this morning. TD Cowen upgrading the stock to a buy on what it expects to be accelerated growth this year, and that's a gain of almost 6% for Lyft.
Yeah, I was really excited to put these two stocks next to each other, Uber and Lyft, because There's a real duopoly here. It's Uber and Lyft, but increasingly it's Uber. You take a look over the past 5 years, Uber has just been dominating Lyft. But you have at least one analyst saying that things are going to get a little bit brighter for Lyft.
Wow,
Maybe that gap will close just a little bit.
That is huge. That's even worse than McDonald's and Krispy Kreme.
Yeah, which we will talk about.
Which we'll talk about.
Deep tease.
A little bit later. Coming up, Carnival cruise results are due in just a few minutes. Analysts expecting a strong second quarter despite concerns about the consumer. That's next. This is Open Interest. Let's get to high interest now. Look at what's making headlines around the world. Jensen Huang sold over $14 million of NVIDIA stock over the last 2 sessions. It's his first transaction under a plan that allows him to offload up to $865 million by the end of the year. According to the Bloomberg Billionaires Index, Huang is the world's 12th richest person, but his fortune is almost entirely tied up in NVIDIA stock. Meanwhile, funds advised by BC Partners are seeking to sell $1 billion worth of Chewy shares in a block trade. The pet product retailer won't receive any proceeds from the sale. Shares are falling this morning on the news because of the obvious concern about dilution. And Starbucks is disputing a report that it's thinking of selling its China business. Caixin Global reported that the coffee company held talks with over a dozen potential partners, including 2 private equity firms, but Starbucks says it's not considering a full sale. The coffee giant has struggled in China due to weak sales and intense competition there. Katie, you still, every day, you still?
No, actually, in this economy, I've started drinking Bloomberg coffee, which really tells you something. But I still go on Saturdays and Sundays for those keeping track at home. But let's talk about earnings. It's still earnings season, Matt Miller, and Carnival Cruise is out with a big one. The company reporting second quarter earnings that beat expectations. The shares jumping pre-market on the news. Let me bring you some of those specific numbers right now. Adjusted EPS came in at 35 cents. The estimate was for 24 cents, so a big beat there. Revenue also a shade higher than the estimate, coming in at $6.33 billion. The estimate had been for $6.2 billion. Here's the commentary, and we'll get more, of course, on the call. But according to the company, our guests continue to look to us as their preferred vacation choice, given the amazing experiences our cruise lines provide. In any case, the shares up 4.4% right now, but the whole complex is on the rise in the heels of this report.
Yeah, very interesting stuff, and the cruise stories have been fascinating to me. I've never been on one of these big ocean cruises, but I have done a Nile cruise as a kid, and Hilton is now getting into that business, and it's just one more of the many hotel businesses that are piling in to the cruise lines. We had a yacht extravaganza with a number of companies doing yachts, and now Carnival, now Hilton, I should say, is doing this one-time thing on the Nile. But
it's a natural expansion, I would assume, going from land to water. I'm sure that will be great for some people who enjoy that. I'm going to stay on land, but do you want to talk about Tesla?
Oh yeah, Tesla. So yesterday was a pretty amazing gain, adding another 10% to its market cap and then some because of the robo-taxi, even though it seemed like kind of a glitchy launch of only a handful of robo-taxis that needed to have company minders in them and were only for influencers and Dan Ives basically to ride around in.
Yeah.
But it's up again today.
And it was a bit of a delayed reaction yesterday, too. It really built throughout the day. So interesting moves in Tesla. Let's talk about Tilray as well. Tilray got Italy's first authorization for medical cannabis, up 3.5%, and that somewhat transitions into Krispy Kreme.
Yeah, well, and I mean, so many of these stories tie together. Yesterday, you were talking about the breakdown of the partnership between Novo Nordisk and Hims and Hers, right? They sell the GLP-1 drugs, which are not helpful, I would imagine, to both McDonald's and Krispy Kreme.
Yeah.
Those two had joined forces and are now breaking up as well. Maybe they figure, like, since Novo and Hims and Hers are no longer cooperating, they no longer need to either.
Yeah, that's a lot of extrapolation, but
the stock, Krispy Kreme, has been absolutely crushed over the past year. It's lost like 5 years, lost 85% of its value. McDonald's is obviously doing much better. And I also think, like, this Tilray story, maybe that helps Krispy Kreme, at least in their Italian locations.
Yeah, a lot of extrapolation, but I like the way you think, like a portfolio manager. We'll have to see if those bets pay off for Matt Miller. But coming up, strategists say that investors should buy the dip in tech stocks during geopolitical uncertainty. We'll see if Morgan Stanley's Lisa Shalett agrees up next. This is Open Interest. Well, Wall Street is saying to buy into market declines on political and economic uncertainty. Among them is Michael O'Rourke from Jones Trading. He says that mega-cap tech is a defensive play during times of uncertainty due to their, quote, safety in size. Let's discuss with Morgan Stanley Wealth Chief Investment Officer Lisa Shalett joining us now. Lisa, great to have you with us. And let's start on that point, because tech, it kind of can fit into any box you want to put it in. For some, it's growth. For others, it's defensive. How are you thinking about tech in this current environment?
Well, one of the first things that I would say is we're not thinking about it as a one monolithic sector. This is a time, we believe, given where the aggregate market valuations are, given where earnings expectations are, and how rich both are, that you've got to be a stock picker and you've got to look for more idiosyncratic value. And so we're finding some of that in, some of the semiconductor stocks, some hardware stocks, some software stocks. But what we're not doing is just buying blindly, quote unquote, the Mag 7 or buying blindly, a passive exposure to generative AI.
If you cling too tightly, Lisa, you're going to lose control. We'll get back to that after this break. Lisa Shalett is staying with us through the open. A check on futures ahead of the opening bell, and we're looking at continued gains here. So after 1% gain yesterday, just about 1% gain, it looks like we could get even closer to record highs. This is Bloomberg. We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller, and I'm pretty excited today because we could see an intraday high, record high reached on the S&P 500. You see futures are up 0.7% as traders are optimistic about Donald Trump's truce in the Middle East. The NASDAQ is up 1%. Tech stocks getting the biggest lift from this peace accord, even if they're both still lobbing bombs at one another. You've got Edwards Life Sciences ringing the bell at the New York Stock Exchange. And over the last 5 years, that stock is only up 11%. So really underperforming the broader index. But they are celebrating their 25th anniversary of listing. And over that time, they're up 4,447%. So outperforming the S&P by 8 times. Reason to celebrate. Down at the NASDAQ, you've got West Banco ringing the opening bell. And over the last 5 years, if you reinvested your dividends there, you double your gains. Katie, in terms of the stocks to watch, actually, you've got assets today because
I do. It's a special day. We're keeping an eye on Brent because that's what stock traders are watching. That's what bond traders are watching. And Brent crude took another leg lower after President Trump said that China can buy Iranian oil. You can see we're trading below $68 a barrel. Now we popped a little bit above it, but really a lot of movement here. And that's rippling through the equities as well, as we've been talking about. I put ExxonMobil and Occidental on the board right now. You can see that Exxon down 2.2% at the open. Occidental a little bit more, about 3% or so. And again, it's energy that's in the spotlight, Matt.
Yeah, absolutely. The key asset to watch over the past couple of sessions. Amazing to watch Brent go from $81 on Sunday night to below 70 and in the 60s today. Uber and Lyft, we were talking about, both up today. Uber is offering Waymo rides in Atlanta, really a continuation of a service that it already offers in other cities. Lyft was upgraded by TD Cowen on potential growth. So both of those stocks are gaining on a rising tide, right? So you're going to see, in terms of the S&P 500 today, when you go ahead and take a look at your move screen, probably some strong breadth. Right now, we have 350 stocks gaining, 130 are down. We're back with Morgan Stanley Wealth Chief Investment Officer Lisa Shalett. And if you're listening along at home, you'll notice that I threw in some 38 special lyrics. That's because Lisa Your note was titled "Hold On Loosely." So first of all, thank you for bringing me back to my childhood. What a fantastic song by 38 Special. But what exactly do you mean by that in terms of how does it translate into a strategy for investing?
Yeah, so look, we recognize that this has been a extraordinarily resilient stock tape. And, positioning, momentum, and hopefulness around both the news flow, resolution on tariffs, resolution on the tax bill, now potentially some resolution in geopolitics, has really, capped a floor under this market. And while we respect those trends, obviously, we look at technicals every day. We are looking at flows and factor moves as well as positioning. The reality is that this continues to be an extraordinarily expensive market, a market where risk premiums in equities are really, really tight. There's just not a lot of value. And that is in contrast to other asset classes, right? We're finding value in international stocks. We're finding value in the bond market, municipals in particular, and some of the asset-backed securities. We're finding, value in real assets, in energy infrastructure, and residential real estate. And so our strategy is, yes, certainly, we are here, we are present, we have exposure to this equity market. We're not trying to make a bearish call, but we're saying don't put all your eggs in one basket. Hold on loosely and be open to diversification, be open to looking around at where there is value in the market.
I want to pick up on bonds because one of the things that you mentioned in your note is that treasuries are actually outperforming equities this year in the U.S. I'm taking a look at IEI. That's an ETF that tracks 3 to 7 year treasuries versus the S&P 500. IEI up 4% on a total return basis. I think that would surprise a lot of people who aren't maybe paying attention that closely because it feels like bonds have been pretty unreliable as a hedge and kind of have a hot and cold reputation right now.
Yeah, I mean, what we're trying to point out to people is I can't think of a year where the headlines have been more bearish for bonds, right? We've gone from expecting, the Fed to be cutting multiple times to potentially not cutting at all to now maybe potentially cutting in the fourth quarter 2 times. We've had worries about inflation linked to tariffs. We've had all kinds of debate about America's debt and deficits and the return of term premiums in the long end of the curve. These headwinds have been pretty meaningful for the bond market and have, caused many to be quite bearishly positioned, particularly in long duration bonds. But to your point, when you look at the total year-to-date returns, it belies those headwinds. And this asset class has proven reasonably resilient, and we're only halfway through the year, and those are pretty good total returns if you're a bond investor.
A lot of misconceptions, I think, when Donald Trump came into office, or it looks like now that tariffs aren't really leading to a lot of inflation. I guess we'll know next month, which we said last month and the month before. What's your take on the debt and deficit picture, though? I mean, does that continue to weaken the dollar? We've seen a 10% decline already from the high.
We are very concerned. And I think what we have to remind people is, while it's very easy to say, look at the last 30, 40 years, there's always been the Cassandras, screaming about the debt and deficits and screaming about, the need for fiscal austerity. The fact is that the mathematics on this are finally shifting. And I think that, folks who, have been more outspoken, like an Elon Musk, for example, understand the math here. And the math here is that we are at a place where if, in fact, nominal GDP growth falls below 4%, which it could in a slowdown or a recession, that means you're actually having to borrow money to pay your interest cost, because interest as a share of GDP today is running at about 3.6%. We also have a steeper yield curve, and interest rates are biased higher. And so that means when we go to refinance, we may be refinancing up 50, 100, 150 basis points, just adding to that interest cost pile. So look, I do think we're in a new higher for longer era in terms of rates. And I do think that interest expense as a share of America's total budget is grinding higher. And that is a constraint that we all have to, care about and pay attention to.
All right, Lisa, got to leave it there. Great to spend some time with you on this Tuesday morning. That is Morgan Stanley Wealth's Lisa Shalett. Meanwhile, let's get a check on this market. The S&P 500 in striking distance of a record high. I believe that's at 6147 on your index. We're trading at about 6070 when it comes to the S&P 500 right now. And that's on really good breadth. You have over 300 names in the green right now, 161 or so in the red. And it's all the names that you need to see rallying right now. A lot of tech up top: NVIDIA, Broadcom, Amazon, Meta, Microsoft. The list goes on. Somewhere down there, you have Carnival shares as well, rising by nearly 7% after that big earnings beat. Let's talk about the losers, though. This is interesting. Energy up top with Exxon down about 1.3%. Then you have RTX and Eli Lilly down a little bit as well. But again, very positive breath. And that's what you're going to see when we zoom out and take a look at the sectors as well. The setup right here, more green than red. Up at the top, you do have the financials. JP Morgan having a good day. Tech, as we talked about, also participating in a big way as well. At the bottom, there are some things to quibble with. Consumer staples down, real estate down, and then energy down by about 0.9%, but certainly a risk-on appetite in this market, Matt Miller.
Yeah, absolutely. Investors, traders, and investors, I guess, want to be long this market right now. Coming up, President Trump is pushing Israel and Iran to abide by the ceasefire that he announced last night. Tina Fordham, Fordham Global Foresight founder and geopolitical strategist, joins us next. This is Bloomberg. This is Bloomberg Open Interest. I'm Matt Miller. Let's get a quick check at what stocks are doing. Just about 12 minutes into the session right now, you have the S&P 500 up 0.8%. 6,076 is still about 70 points away from an all-time high. I think Katie just said it was 61.47 on an intraday level, 61.44 on a closing level. But it does look like the market wants to get there. Certainly, Dan Ives put out a note this morning saying that that's where we're headed. NASDAQ 100 gaining more than 1%. So bigger gains for the tech stocks, which is why Dan is so bullish. If you take a look at a few assets here that normally I'd go straight to stocks, but the 10-year yield holding steady. We're awaiting Jerome Powell's testimony on Capitol Hill, and we're going to bring it to you live as soon as he starts to talk. He says the Fed is in a great position to wait on cuts. Brent crude right now down another 5%, $68 right now, and we saw $81 on Sunday night. So that's a pretty amazing, like 16% move in just a couple of days. Tesla was up in the pre-market. Now it's down, but not a huge move there. Uber and Lyft are both gaining right now. Uber up 4.5%. Carnival Cruise beating expectations on earnings, up almost 10%. And American Airlines, a little bit of a recovery from yesterday, and also up, obviously, on that Truce. The truce is not helping Lockheed Martin, and because of the falling oil prices, you can see Occidental, Katie, down as well.
All right, President Donald Trump says that fragile ceasefire he announced between Israel and Iran is still intact. On Truth Social, he wrote, quote, Israel is not going to attack Iran, adding that the ceasefire is in effect. Now, this comes after Israel accused Iran of breaching the truce earlier this morning. Let's unpack the situation with Tina Fordham. She is founder and geopolitical strategist over at Fordham Global Insight. It's great to have you with us, Tina. I want to go to this line in your notes because this certainly caught my attention, that we regard it as a meaningful probability that Israel will be tempted to, quote, finish the job and push harder in an effort to deal the Iranian regime a fatal blow. So let's start there. What does finish the job mean in this context, and what would that mean for the relationship between Israel and the U.S.?
Well, I think we're in the midst of what can only be described as geopolitical whiplash, right? One minute we have a ceasefire, the next minute it appears that it's been challenged. And Donald Trump has said to both Israel and Iran that if they don't abide by the ceasefire, he's going to turn this car around and drive home. We know that he has famously short attention span for this sort of thing. But when it comes to the trajectory for this conflict, I think we should consider the ceasefire a pause. Certainly, Iran would like to draw a line under this episode. It wasn't prepared for the Israeli attacks. It has been really undermined and weakened by this 12 days of fighting. They're now calling it a 12-day war. But as I said in our note to clients, I think that there is reason to be concerned that Israel hasn't gone far enough. We don't know where the highly enriched uranium stocks are, and the temptation will be to push the regime until it collapses, even though, in my view, that risks unleashing a great deal of uncertainty.
Yeah, it seems like they will want to finish the job. But even if the truce holds, even if the ceasefire is maintained, Tina, and we go into negotiations, I don't get the end game. Like, what's the point? You haven't been able to trust this regime since they kidnapped 52 Americans in 1979 and held them for 444 days. None of the, peaceful diplomatic negotiations to stop Iran from enriching their uranium worked. Obviously, they were, doing it 300 feet underground for a reason. So what would we accomplish in negotiations?
Well, I think the question is really what are the risks of a fatal blow to this regime, right? I mean, it's possible for weak regimes and weak states to actually stick around for quite a long time. And it wasn't that long ago, Matt, that we were, thinking about getting rid of Saddam Hussein in Iraq and Gaddafi in Libya. And in both cases, the power vacuums that resulted generated a lot of what people like me would call unintended consequences. So this regime is not friendly to Israel or the United States, and it's a thorn in the side to its neighbors. It's an ally to Russia, to China, to North Korea. No question that it is a destabilizing force that has acted through its proxies to create a great deal of damage. But the question really is, be careful what you wish for, because Iran is twice the size of Iraq, which tied down the United States in the Middle East for a long time. And the record of inorganic regime change, as I diplomatically called it, isn't great.
Right. So just to draw a line under that point, you're saying that in this situation, regime change, which is certainly something that was theorized over the weekend, not a realistic scenario in this situation.
Not necessarily an optimal scenario is what I'm suggesting. The aftermath of, again, recent examples of attempts at regime change didn't bring about stable, democratic, Western-friendly governments. And so those who are suggesting that might happen in the case of Iran, I think, are dreaming. It's unlikely that a non-Islamic leader would follow. And very often when authoritarian regimes do collapse, they often are followed by even more difficult regimes. Venezuela is an example.
Yeah, so stuck, it seems, between a rock and a hard place for now. Tina, great to get some of your time. We will continue to watch your research and have to have you back on soon. Tina Fordham there of Fordham Global Foresight. Coming up, Carnival sailing easy in the second quarter, beating expectations. We'll break down this morning's report and talk more about the cruise lines next. This is Open Interest.
Welcome back to Open Interest. It's time now for our top calls. Some of the analyst action in focus this morning. And first up, Goldman Sachs downgrading Dollar General to neutral, seeing limited upside gains given its recent gains and that competitive environment. Shares down almost 4%. Next up, we've been discussing this call. TD Cowen upgrading Lyft to a buy, saying the company is well positioned for accelerated growth this year. Shares up about 3% at the moment. And finally, this is a hot one. Compass Point initiating coverage on Circle with a neutral rating, warning about weakening gross margins and mounting competition. That is dragging Circle shares down a little bit this morning, down 1%. But Matt, as you know well, what a run this recent IPO has had.
Yeah, they're only up 8.5%, 8.5 times, I should say, now from their IPO, which went at $31. Let's talk about the cruise lines, because Carnival is soaring this morning. The stock up after raising its full-year profit outlook. Joining us now is Brian Egger, Bloomberg Intelligence senior gaming and lodging analyst. And, you know, this is interesting, Brian. This morning I was wondering, is there an ETF where you can short the cruise lines? Because I was concerned that, you know, they're overhyped. The demand is overhyped, but it looks like smooth sailing for now.
Yeah, I think that's a fair point. We were a little concerned going to the quarter because Norwegian Cruise Lines trimmed its full year 25 yield growth outlook by 50 basis points back in late April after Liberation Day. Carnival's last print was in late March, so we haven't heard from them since then, but actually they modestly raised guidance. Most of that strength was from the just reported second quarter, but they see a pretty stable second half.
It's a good thing that you didn't short the cruises this morning, because you would have lost a lot of money. I want to talk about the group.
Sure.
Because you take a look at the long-term performance. You have Carnival doing pretty well. You have Norwegian doing pretty well. Then you have Royal Caribbean absolutely crushing it over a 5-year basis. Yeah, the chart is pretty amazing. Hopefully we can pull that up. But what explains that? Because I think a lot of people tend to think about the cruises as a block and perhaps trade them that way.
Yeah, I think Royal Caribbean's had a lot of great new hardware. They've really focused on onboard experience enhancements. The truth is, all of these companies have. I think Royal has maybe outperformed more recently. You know, but this has been an industry that fairly consistently over decades has maintained fairly solid, at least inflation level yield growth with mid-single digit supply growth.
Dude, look at these numbers here.
It's nuts.
Royal Caribbean up 500%.
Yep. Yeah, I mean, certainly from a return perspective, well, all these companies are at this point targeting low teen kind of returns on invested capital. Royal Caribbean's arguably done a great job getting there quickly.
We don't have much time with you left, but I have a quick question when it comes to these geopolitically fraught regions, how important they are for these cruises. We've spoken with the CEO of Norwegian before. He was telling us that their St. Petersburg line was so profitable they can't run it. When you think about what's going on in the world, I mean, how much are these C-suites rooting for peace, basically?
Right, well, they certainly are rooting for peace, but the geographic diversification of the lines definitely helps. You know, even the Red Sea cruises to Israel is only 1.5% roughly of capacity days for Royal. So while it's a factor, because they're so geographically diversified with most of that capacity in Europe and the Caribbean, they get a little bit of diversification, helps them in terms of the exposure to these geopolitical events.
All right, great having you on, Brian. We need to talk, I think, more about cruises.
Definitely.
We have Brian on more because I think it's just a fascinating business. Brian Egger there, Bloomberg Intelligence. In terms of the moves in the broader market right now, we continue to see gains. We're not yet at 6,100, but we're back up over 6,000 at 6,066.
And you have big tech in the lead, as you can see with the NASDAQ 100 leading gains. So if that continues, that bodes well for the S&P 500 and those all-time high hopes. Keep it here. A lot coming up in the next hour, including Fed Chair Jerome Powell testifying on Capitol Hill. This is Bloomberg.
All right, happening right now on Capitol Hill, Fed Chair, move out of the way, dude. Fed Chair Jerome Powell is set to testify before the House Financial Services Committee. His testimony comes as the Fed tries to navigate a new tariff regime, harsh criticisms from the White House, and now the conflict in Iran. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Sonali Basak. As we wait for Powell's testimony, we're going to take a check on these markets. As Matt has been saying throughout the morning, we are looking for the S&P 500 to touch new intraday highs. You're still seeing it up about 0.7% this morning. Brent crude laying low at about 68.25 right now. We were as high as 81 over the weekend. So extremely volatile oil prices, but a cooling. And those two-year yields here are really interesting just because you have traders keeping their eyes on 2 rate cuts this year, even with Powell pledging patience.
Yeah, I think it's interesting. We saw 10-year yields coming down as well, and then those gains started to fade. You can see that the S&P still needs another 80 points to go until a high. So we may not make it today, but Dan Ives was out with a really bullish note this morning saying this ceasefire puts tech stocks front and center. I don't really know how he made the jump from one to the other, but certainly the NASDAQ is outperforming the S&P this morning.
Well, when you're covering tech stocks sure look good, but we also have consumer confidence data.
When you're a hammer.
Yeah, everything looks like a nail. Consumer confidence data, speaking of things getting nailed, this is something that missed estimates. The estimate was a 99.8 reading. It fell down to 93. We are at session lows on the S&P 500. We're going to bring in now Bloomberg's Michael McKee, the international economics and policy correspondent in Washington. How is this data, Mike, going to play into some of what we might hear from Fed Chair Powell today?
Well, in his prepared text, Sonali, the Fed chair says that consumer confidence and business confidence has fallen, and they're not sure how that's going to translate into what happens in the economy, but it could suggest that maybe people pull back on spending. When you look at the data from the conference board, both the present situation and the expectations numbers went down. The present situation significantly, 129.1 from 135 from 135.5. Yes, it's a revised. That's why I'm stumbling there. The point being that some of this Iran and Israel stuff maybe made it into the end of the survey for the conference board, and people look at where the economy is right now, and they were worried about that. If the ceasefire holds, maybe that changes as the numbers did last month when we heard a little bit better news on tariffs. The other thing you can say about the conference board numbers is they're very dependent on what people think of the job situation. And right now, people think that jobs plentiful are going to be fewer than they thought last month. 29% think that they will be fewer, 52.7% think that they will be the same, and 18.1% think that there will be more jobs. So at this point, people are still somewhat pessimistic about the labor market going forward. And we'll see how people work that into their forecasts for the jobs numbers next week. Yeah, we saw obviously Israel attacking Iran on June 13th. So it was 11 days ago, and that fell in the conference board's, the end of the conference board survey there. Mike, I want to ask, though, about rates and the pressure that President Trump has put on Jerome Powell. If the Fed chair were to fold, would that have the intended effect? President Trump says, cut rates by 200 basis points so we can pay less interest on our $37 trillion of debt. If the Fed chair was seen to fold in terms of independence, would we see rates go down longer into the curve? Longer into the curve, they might go up because markets might think the Fed has lost credibility in its inflation fighting. And if the markets think that there is a good chance of inflation coming from the tariffs, then it would work in the complete opposite direction. And the thing is, Matt, we don't know what the tariffs are going to be. The reciprocal tariffs don't come back until July 9th. And there's still tariffs on semiconductors, copper, pharmaceuticals that are hanging out there that the president intends to impose. So there's a lot we don't know about the situation. Also, if Jay Powell were to fold, it doesn't mean the rest of the committee will fold. We heard from Raphael Bostic today in a Reuters interview saying he doesn't think that they should cut rates until the end of the year and maybe only once. And Beth Hammack from Cleveland saying that she thinks that it could be quite some time before rates go down. So the rest of the committee seems to be more in line with Powell's stance so far rather than what we've heard from Mickey Bowman and Chris Waller lately.
Mike, we thank you so much for your time. We're looking forward to your reporting later in the day. That is Bloomberg's Michael McKee. And Matt, I just want to point out here, a lot of people point out this data as very politicized. In this case, you're actually seeing the largest decline among Republicans. I did want to point that out because I think this is going to play very interestingly into the midterms and certainly in what we might hear today from lawmakers as they question Chair Powell.
You're talking about the consumer confidence data, and we can actually graph that. Michael McDonough and his team at 120 Park have done that. So we'll do our best to bring you a chart of Republicans' consumer confidence versus Democrats' consumer confidence. In the meantime, the ceasefire agreement between Iran and Israel appears to be holding, I guess, over the past few hours at least, after President Trump accused both sides earlier of breaching the deal. President Trump is on his way to the NATO summit in the Netherlands. Let's bring in Bloomberg's chief political correspondent, Anne-Marie Hordern, who's on the ground there, as well as a Bloomberg Washington correspondent, Tyler Kendall, who is on Capitol Hill. And Anne-Marie, I'll start with you and just want to get sort of a wrap of what the other European leaders are saying in response to this ceasefire that it looks like the president has negotiated on his own.
At the moment, the ceasefire is holding, but it is vulnerable, and that's obviously a cause for concern for officials on both sides of the Atlantic and, of course, as well in the Middle East, in the region. I think President Trump will be met here with two different viewpoints when it comes to the U.S. strikes and the Israeli strikes as well on Iran. You have Emmanuel Macron, the French president, talking about the fact that he thinks these are illegal strikes coming from the United States, even though he does agree with the U.S. that Iran cannot have a nuclear weapon. And then we hear from the German chancellor, who said that Israel was doing the, quote, dirty work when it comes to their strikes on Iran, and said that really he has no reason to criticize Washington or Jerusalem. We also recently just got a little bit of insight into what the Secretary General, Mark Rutte, has been saying to the president. The president released a private text message from the Secretary General to him. He talked about the fact that no other president could have been doing what he did in terms of decisive action when it comes to Iran. Talked about the fact that he's able to convince all the NATO members to get to 5% of defense spending. We should note that is going to be calibrated differently, 3.5% for hardcore military assets, and then another 1.5% if you want to use to really develop the defense industrial bases, things like cybersecurity, border protection, et cetera. You have a little bit of a leeway there. And then he talked about how Europe is going to, quote, play big. So the president is going to be walking in potentially with some different viewpoints at what's going on in the region, this vulnerable ceasefire. But the fact of the matter is, he has been lambasting the alliance to pay more of their out of their GDP for defense, and it looks like he's going to get that win here at The Hague.
Anne-Marie, one more to you as well here, because this truce has been so fragile throughout the morning. What would then now upset the apple cart?
Well, you could see potentially another strike from the Israelis or the Iranians on either of those territories. When the president came out very early this morning briefing reporters, he talked about the fact that he was upset with both Tehran and Jerusalem. And he said, but he's very upset with Israel because Israel was saying they were going to retaliate. The defense minister came out and said that they were going to have the IDF retaliate for the latest missiles sent over by Iran. And the president did then send out another Truth Social post saying that they were not going to do so. And he spoke on the phone, the White House, saying that he was firm on the phone with Prime Minister Benjamin Netanyahu. I spoke to one longtime observer of the region, though. I think this is something we should really take into consideration as the next few weeks unfold. Ceasefires, especially in the first 24, 48 hours, especially in the Middle East, they could be very fragile. But going forward, how does Israel now view Iran? Does it view it the way it views, say, Lebanese Hezbollah in Lebanon, where it sees intelligence of a potential threat and then wants to neutralize that threat? Could Israel now view Iran in the same way, where, say, in 2, 3 weeks, months' time, they see a potential threat? Would they then take it onto themselves and potentially have another strike. And that is why many people say that we are just in a different environment now, seismic shift when it comes to dynamics in the Middle East.
Tyler, I want to get to you on Capitol Hill, and hang on, is Jerome Powell going to start speaking? Unfortunately, Tyler, I'm going to have to say goodbye. We'll talk to you later. Anne-Marie, thanks very much for that. Let's get to the Fed chair on Capitol Hill.
Annual monetary policy report. The Federal Reserve remains squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Despite elevated uncertainty, the economy is in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has come down a great deal, but has been running somewhat above our 2% longer-run objective. We are attentive to the risks on both sides of our dual mandate. I will review the current economic situation before turning to monetary policy. Incoming data suggests that the economy remains solid. Following growth of 2.5% last year, GDP was reported to have edged down in the first quarter, reflecting swings in net exports that were driven by businesses bringing in imports ahead of potential tariffs. This unusual swing has complicated GDP measurement. Private domestic final purchases, or PDFP, which excludes net exports, inventory investment, and government spending, grew at a solid 2.5% rate. Within PDFP, growth of consumer spending moderated, while investment in equipment and intangibles rebounded from weakness in the fourth quarter. Surveys of households and businesses, however, report a decline in sentiment in recent months and elevated uncertainty about the economic outlook, largely reflecting trade policy concerns. It remains to be seen how these developments might affect future spending and investment. In the labor market, conditions have remained solid. Payroll job gains averaged a moderate 224,000 per month in the first 5 months of the year. The unemployment rate at 4.2% in May remains low and has stayed in a narrow range for the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance and consistent with maximum employment. The labor market is not a source of significant inflationary pressures. The strong labor market conditions in recent years have helped narrow long-standing disparities in employment and earnings across demographic groups. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total personal consumption expenditures, or PCE prices, rose 2.3% over the 12 months ending in May, and that, excluding the volatile food and energy categories, core PCE prices rose 2.6%. Near-term measures of inflation expectations have moved up over recent months, as reflected in both market and survey-based measures. Respondents to surveys of consumers, businesses, and professional forecasters point to tariffs as the driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. With the labor market at or near maximum employment and inflation remaining somewhat elevated, the Federal Open Market Committee has maintained the target range for the federal funds rate at 4.25% to 4.5% since the beginning of the year. We've also continued to reduce our holdings of Treasury and agency mortgage-backed securities, and beginning in April, further slowed the pace of this decline to facilitate a smooth transition to ample reserve balances. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. Policy changes continue to evolve, and their effects on the economy remain uncertain. The effects of tariffs will depend, among other things, on their ultimate level. Expectations of that level, and thus of the related economic effects, reached a peak in April and have since declined. Even so, increases in tariffs this year are likely to push up prices and weigh on economic activity. The effects on inflation could be short-lived, reflecting a one-time shift in the price level. It's also possible that the inflationary effects could instead be more persistent. Avoiding that would depend on the size of the tariff effects, on how long it takes for them to pass through fully into prices, and ultimately on keeping longer-term inflation expectations well anchored. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. As we act to meet that obligation, we will balance our maximum employment and price stability mandates, keeping in mind that without price stability, we cannot achieve the long periods of strong labor market conditions that benefit all Americans. For the time being, we are well positioned to wait to learn more about the likely course of the economy before considering any adjustments to our policy stance. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you, Mr. Chairman. We'll now turn to member questions. I recognize myself for 5 minutes for questions. Over the past few weeks, our Democratic colleagues have suggested the following. After the initial release of the GDP report, the president is driving the economy into a recession. Chairman Powell, the latest FOMC statement described economic activity had to continue to expand at a solid pace, and you just reiterated that in your testimony this morning. In your view, is the term recession and the economy growing at a solid pace, are those synonymous with each other?
I would say no.
And you note that the labor market continues strong, the economy's at a standard pace, and you also referenced in your testimony that that first quarter GDP initial react was also from front-end loading, as you noted, imports to try to avoid tariff impacts. Also, I looked at the Atlanta Fed GDP Now model, which forecasts GDP growth for the second quarter of this year at nearly 4%, with core GDP forecast at 2%. Does that Atlanta model suggest a recession to you?
No, I would say it doesn't.
So in looking at your remarks about tariffs today and then the ones that you made during March and April, I was looking back at a Fed study that noted that up until March, tariffs have already been partially passed through in consumer prices, leading to a contribution of merely 1/10 percentage point increase in core PCE prices. And a Harvard study last week showed that prices have only modestly adjusted since the announcement of tariffs. Finally, the longer-term inflation expectations remain consistent with the 2% goal. Governor Waller laid out a pathway that allows for rate cuts provided that average effective tariff rates remain close to 10%, or I assume he means 10% or lower. The labor market remains solid. Prices continue to disinflate. So given that data I've outlined, I'm sure data that you're very familiar with, for the economy to avoid persistent inflation, do you concur with Governor Waller that there is a pathway for good news as it relates to the regulatory policies, the tax policies that I've discussed, in a world with lower tariff rates?
So first, I wouldn't comment on any other FOMC members' comments one way or the other, but I will say this. I think many paths are possible here, and certainly the one you mentioned is a possible one. We could see inflation come in not as strong as we expect, and if that were the case, that would tend to suggest cutting sooner. We could see the labor market weakening, and that would also suggest cutting sooner. On the other hand, if we see inflation coming in higher, or if the labor market were to remain strong, then we would probably be moving later. So I think a range of possible paths are possible, and certainly the one you mentioned is one of them.
In February of 2021, you told us in this committee that you would stay in your lane and not comment on President Biden's proposal for the American Rescue Plan or sharply increasing federal spending. And, you said it was an issue, but that you would stay in your lane and not comment on it. But here in this year, you have commented on this idea of tariffs being set by the executive branch. So are tariffs in your lane, but a huge fiscal spending by the Biden administration not in your lane? Explain to the committee why you chose to be silent in February of 21, but outspoken this spring.
Sure. So we haven't commented, and it would be inappropriate for us to comment on the policy of tariffs. We don't have a view. It's not our job, and we just wouldn't do that. And just as we wouldn't comment on the reconciliation package that you're working on right now. We're not commenting on tariffs. What our job is inflation, keeping inflation under control, and also keeping maximum employment. And when policies have what appear to be short and medium-term implications, meaningful implications for that, then they kind of, not the policies themselves, but the inflation becomes our job.
Yeah. You know my views on price stability. I think it's a first among equals in your dual mandate. I've argued for that. I've introduced legislation to make the dual mandate the sole mandate, and we've talked about that before. But I was very curious about your thoughts on former president of the Cleveland Bank, Loretta Mester's quote that I read from last fall. She says, "I think that maximum employment is the maximum level of employment consistent with price stability." In other words, she elegantly ties that together, that price stability is what you can have more control over rather than, all these other factors that enter the employment picture like legislative and executive branch. What's your thought about her quote?
I personally think that's a very reasonable way to think about it.
Thank you very much. I yield back. The gentleman from New York is recognized for 5 minutes.
Thank you, Mr. Chairman. Good morning, Mr. Chair, Chair Powell, and thank you for being here. Last week, the FOMC decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. While I was not surprised by the decision to hold rates steady, I was surprised by the committee's revised forecast since March, which represented a decrease of 0.3 percentage points for GDP, a similar increase for core PCE, and an uptick in the unemployment rate to 4.5%. Can you explain the incoming data that the committee has seen since March that caused it to make these adjustments?
Sure. So, first of all, these are individual. This is not a committee forecast. These are just individuals submitting their own personal, forecasts, and we don't bless those as a committee. But I think people are looking at the incoming data and having a range of different judgments. If you look at the range, if you look at the central tendency, you'll see that it covers quite a wide range. Those are the medians that you're talking about. I think so. Inflation is projected to have moved up because of what we've seen, particularly from tariffs. And I think if you look at other outside forecasters, you'll see very much the same thing.
And what data are you looking for?
Well, we look at the incoming data on. We look at our own forecast and we ask ourselves what's likely to happen. Monetary policy has to be forward-looking. A forecast is a prediction of what's going to happen in the future.
Thank you. In its statement, the committee announced that it will continue to monitor the implications of incoming data and adjust the stand of monetary policy as appropriate. Some analysts predict 2 rate cuts by the end of the year are still on the table. Is this a fair and accurate assumption? And what incoming data will the committee need to see to consider these cuts?
So what will actually happen with rates is going to depend on the path of the economy, and that's highly uncertain. So I would just say what that means at this moment in time is that a significant majority of the committee, but also there's a pretty significant minority that doesn't agree, but a significant majority feels it will be appropriate to reduce rates later this year. And what that means is that each of those persons who wrote down a cut in rates later this year, they think that there's some state of the world where inflation doesn't prove to be as high, or the labor market weakens, or some combination of those two things, that it will turn out to be more likely than not appropriate to reduce policy rates, subject to great uncertainty. I mean, we will, the story has been evolving, and our thinking has been adapting, and that will continue.
Thank you. Chair Powell, although a ceasefire has been tentatively reached in the Middle East, the situation still has the potential to open global and energy markets, especially if the ceasefire is broken, while at this point Iran is seen as unlikely to close the Strait of Hormuz. That decision could change. How is the Fed assessing the current situation and incorporating those assessments as it considers future adjustment to economic projections and its stand on monetary policy?
So I think it's too early to know what any economic implications might be, and I would not want to speculate like everyone else, we are, of course, watching the situation.
Thank you. And Chair Powell, after reviewing the economic data following the meeting last week, it seems to me that the committee is indicating that we could be headed for a situation where inflation accelerates while unemployment rises and growth become more sluggish. In this scenario, this will put the Fed's dual mandate of maximum employment and price stability in tension with one another. In this scenario, how does the Fed balance these priorities in order to achieve both mandates?
So let me say that we're not facing that right now, and that isn't really our forecast that we will face such an issue in a serious way. But if that does happen, then what we do is we look at the two goals and we see which one of them is farther from its goal. Two variables, is maximum employment or price stability farther from its goal, and we prefer the one that's farther than its goal. And then we also ask ourselves, how quickly will they return to goal? It's a very difficult situation for any central bank, and I would say again, we're not in that situation right now.
Thank you, Mr. Chairman. Yield back.
The gentleman's time has expired. The Vice Chairman of the full committee, Mr. Heising of Michigan, is recognized for 5 minutes.
Thank you, Chair Hill and Chair Powell. Good to see you again. I got a lot to cover, so we're going to try and keep this concise. But following up a bit on what Chair Hill had been talking about, you had said in January 29, 2025, quote, "We don't know what will happen with tariffs, with immigration, with fiscal policy, and with regulatory policy." I would add energy into that, by the way. "We need to let those policies be articulated before we can even begin to make a plausible assessment of what their implications for the economy will be. This is no different than any set of policy changes at the beginning of the administration." However, December 18 of 2024 at the FOMC press conference, you noted, and I'm paraphrasing, that some Federal Reserve officials began to incorporate preliminary conditional estimates of how fiscal policies might impact the economy into their forecasts. This seems inconsistent, and I sidebarred with the chair to say, okay, did I hear this correctly, his question and sort of your answer? What I heard is that there was a belief that the IRA would not be inflationary, but that tariffs could be, therefore, suddenly you and others were commenting on tariffs. And for the institution, I know you try to be consensus driven. Why are there FOMC participants making fiscal policy assumptions into their forecasting when you yourself said that fiscal policies need to be articulated before the FOMC can make a plausible assessment into their implications, what those will be? And I think if there's different participants having different assumptions, that would render the SEP, Summary of Economic Projections, biased, meaningless, useless, less impactful, and when you're not comparing apples to apples. So wouldn't it make more sense for all the forecasters to make the same fiscal policy assumptions at the same time? Or if not, shouldn't each participant disclose what assumptions that they're using and building into that? So here's the question.
So that's a great question. That really, when the Summary of Economic Projections was originally designed and put into effect in this way, the way it works is that individuals are free to make whatever assumptions they want, and they do disclose them. They disclose them in their speeches and things like that. So there will be situations where some people incorporate something and others don't, and we try to be transparent about that. But that's kind of the way it works. When I say we don't take it into account, I'm really talking about policy and the committee as a whole, where we won't take things into account until we know.
And you believe that the participants disclose their assumptions when they're doing their forecasts?
Well, I think they do that in their speeches. Each people go out, and you may have noticed there are a lot of speeches.
Well, I guess the opaqueness of the Fed has been something over the arc of my 15 years on this committee has been one that has been debated greatly, including auditing the Fed and a number of other things that have gone on. I've got here a brief moment. I do feel like I need to touch on interest rates. Not to be a shock, you asked how the family business was doing back in Michigan. Families involved in sand and gravel and aggregates and construction and things like that. It's been strong. We need more labor. We need a few other things on that, what's happening. But I think there's no recession. That's been established. There's no hyperinflation, or certainly not as what some had been projecting. Yet there seems to be higher than expected or certainly desired interest rates for many of us. And I'm curious how high interest rates, they hurt Americans who are paying car loans, credit cards, mortgages. Just this morning, you had FHFA Director Pulte asking for lower interest rates, which would obviously impact home buyers as well. So what is it that's keeping, in your mind, the Fed from what many of us believe is the right thing to do, which is to lower some interest rates and, by the way, match what the Bank of Canada, Bank of England, the European Central Bank, the Swiss Central Bank, a number of emerging central banks. By the way, that's your own assessment on page 33 as where you're laying that out. Why aren't we doing what the rest of the world is doing? Is it because we're at full employment? Is it because of those tariff concerns that you said weren't part of the analysis? Was it energy, groceries, durable goods? Why?
So you're right that if you just look in the rearview mirror and look at the existing data that we've seen, you can make a good argument that that would call for us to be at a neutral level, which would be, a couple of cuts or maybe more kind of thing. The reason we're not is the forecast by all professional forecasters that I know of on the outside and the Fed do expect a meaningful increase in inflation over the course of this year. When I said we weren't going to talk about tariffs and inflation, that was to say until we see what the policies are. And so now we know a lot more. It's 6 months since I said that. So anyway, I'd be happy to continue this with you.
Thank you.
Gentleman's time has expired. Gentleman from Michigan, Ms. Tlaib is recognized for 5 minutes.
Thank you so much, Mr. Chairman. Chair Powell, last month there was research published in the Journal of Urban Health that found that more than half of Black women of reproductive age, that's the term they use, in the counties that I represent, that had experienced some sort of eviction during their lifetime. So that's like 50% of Black women in the two largest counties, Wayne County and Oakland County in Michigan. And these numbers are horrific. As you know, were you aware of that?
No, I was not.
And evictions are often very traumatic experience, but also it creates a cycle of poverty, but also this instability for many families. But especially when it comes to a lot of our Black neighbors, the access to equity, the access to housing is diminished even more. In Michigan, we lost more Black home ownership than any other state in the country during the last recession. So we know the housing crisis, I believe, is structural, and some may say it's a policy choice. While there are many factors at play, and you know this, Chairman, high mortgage rates, the finance rates and so forth, that drag the supply of new housing. But last month, new housing hit a 5-year low. Are you familiar with that?
I'm not sure exactly what statistic you are referring to.
Okay, I don't know. There was all this articles about the housing market and the impact of tariffs and so forth, and they said, again, it hit a 5-year low. And again, I'm getting this from a source. But this sets the market up for higher inflation and more burdensome housing costs to years to come. So Chairman Powell, I'm looking at this monetary whatever policy framework that you guys have put together. Do you think that the way it's structured, and again, I'm trying to understand how you're looking at this in the housing crisis, do you believe it's eroding new rental supply under construction right now, leading to high inflation in future years?
So I think there are two things going on quickly. One is just there's a longer run shortage of housing in the United States, which there's nothing that the Fed can do about. That's not something we can affect. Well, there's also, if I may say, in the short run, rates are high, and that's going to weigh on housing activity. But the best thing we can do for the housing market, the absolute best thing, is to restore price stability so that rates come down and so that rates can be at a level that people can afford. But don't you think that the
restrictive monetary policy the framework you all put together undermines long-term price stability right now by reducing the supply?
No, I mean, I think it restores price stability. The point of higher raits is to...
So you don't think the higher rates is impacting future supply of housing?
So I think what that does is, I think interest-sensitive sectors like housing are very much directly affected when we cut rates or when we raise rates. That's right. But that's part of the mechanism for restoring general price stability.
So keeping the high interest rates does not impact future supply of housing?
does not, over the long,
I need to go back to talk to
over the long
women
run,
that the study
Fed will not be, our policy will not be a driver of longer run housing supply in the United States.
Let me ask you, what is the difference? And I'm honestly confused. I want to learn here, and I'm sure people listening to this want to learn. What is the difference between demand-driven rent inflation and supply-driven rent inflation? Like you guys use these terminology. What is that? How do I communicate that to the public? What is the difference between supply-driven versus demand-driven rent?
Those are not terms that we use particularly often.
What's supply-driven formula?
That would mean that there's not enough supply to meet demand, but at the same time, it also means there's more demand than there is supply.
So are you guys ignoring that?
No, but as I said again, our policies will not affect in the long run.
No, I'm being
either
serious,
demand
I
or
see somebody
supply
behind you
in
kind of
housing.
I'm being serious, y'all. We're talking about a housing crisis that is getting worse right now because we're not paying attention to future instability that the current rates, and you can raise your eyebrows and all this stuff behind. I don't know. I mean, do you understand? Like, I come from a community right now that I believe is now being impacted by the current framework that you're putting together, that I do feel like it's going to be long-term effects on the housing crisis, and you're ignoring it.
No, we're not, actually. We think the very best thing we can do is to fully restore price stability at the aggregate level. That will be the best thing for homeowners and for home builders and everybody else. That's in the long run, that is the single thing that Congress has assigned us to do.
But you see where I'm coming from. It is impacting future supply of housing, right?
Not in the long run, no.
Okay. Well,
Gentlewoman's
Mr.
time
Chair,
has
thank
expired. The gentleman from Wisconsin, Mr. Stile, who's also the chair of our subcommittee on digital assets, financial technology, and artificial intelligence. You're recognized for 5 minutes.
Thank you, Chairman Hill. Thank you, Chairman Powell, for being with us today. I want to dive into two actions the Fed's recently taken to get a little additional color on. Yesterday, the Fed announced that reputational risk would no longer be a component in bank exams. I viewed that positively. I viewed the reputational risk as often being a catch-all for political bias. I think it's positive to depoliticize bank exams and instead focus on the core and measurable risks. Could you provide color as to whether or not any new information came to light that led to the decision of the Fed to remove that yesterday?
I'm not aware of any new information. No, we just think it's the right thing to do, and of course made an announcement on Monday under Governor Bowman's, Vice Chair Bowman's leadership.
Why would it not have been done previously if it's the right thing to do? I agree with you, it's the right thing to do. Why was it? Any timeline as to why that was done yesterday versus previously?
No, I think this is a problem that we came to understand as a problem over the course of the last couple of years, and began considering what's going on here. We're hearing a lot of reports of debanking and that sort of thing. And over the course of really 2024, came to the view that this was a serious problem that we need to address. And we've said that publicly, and now we're doing this, and so are the other agencies, by the way.
I appreciate you taking that action. I do agree that there were real political bias in some of those exams, in particular as it related to regulated entities engaged in the digital asset space. Let me shift into the digital asset space if I can. Another action recently taken by the Fed, the Novel Activities Supervision Program was ended and withdrew several statements on digital asset related risks that deterred bank involvement in particular. You in the Fed and others at the Fed have spoken positively about the House and Senate work to regulate stablecoin in particular, a real opportunity to dollarize the globe and be a significant purchaser of U.S. Treasuries. Following that action by the Fed, have you seen an identifiable shift in banks or other regulated entities as it relates to engagement in the digital asset space?
I wouldn't be the one to be picking that up first, but what I do see is a very significant change in the tone, and it really does reflect evolving thinking and the evolving status of the crypto industry. And I would expect over time we'll see more activity.
How is the Fed evaluating and overseeing banks or other regulated entities that are in the digital assets or crypto space?
So our view is that banks get to decide who their customers are. That's not our decision. And so banks are free to provide banking services to the crypto industry, to crypto companies, and banks are also free to conduct crypto activities as long as they do so in a way that is, protective of safety and soundness.
Thank you very much. Let me shift gears because I want to give you just a little bit of an opportunity to comment on the housing sector once again, but give you a little freedom here to speak to that area. You correctly are trying to balance inflation and price stability, but also higher rates have a significant impact on the housing market as shelter and housing costs are a significant driver of why many families can't afford the things that they need. Can you provide color as to how you're analyzing the impact that housing and shelter costs have on families and on inflation with your desire to maintain price stability at the interest rates that is currently set by the Fed?
Sure. So, we realize that people are feeling high housing costs and high financing costs. In terms of inflation, we look at something called owner's equivalent rent and rentals, and that's meant to capture both rented housing and owned housing. And it's been very sticky. It's been one of the stickiest parts of inflation. I'm happy to say now it actually is coming down quite regularly. That's very good news. That's been the part, really, it's been the service inflation that's been stickier than other parts of inflation. So that's good news for people, I think, and it is showing through into measured inflation now. Again, in the long run, the best thing we can do is restore price stability and let the market work. Even then, though, we're still going to have a housing shortage.
What data do you think is leading to the reduction in the rent equivalent?
I just think it took time. So the thought is when you would think that if rents come up every year, you would think it would take 1 year or 2 years for a lack of growth in rents to show up in a lack of growth in housing prices. It turns out it takes 4 years or 3 years. If you're an existing tenant, it's a complicated thought, but if you're an existing tenant, you don't actually catch up the way you would if new tenants came in. And so that's made the measurement of inflation stickier. But I'm happy to say we've been through that period now, and we are really seeing now housing services inflation pretty close to where it was when inflation was solidly at 2%.
Thank you. I yield back.
Gentleman yields back. Gentleman from California, Mr. Liccardo, is recognized for 5 minutes.
Thank you, Mr. Chair. Mr. Chairman, thank you for your testimony today. I appreciate that your dual mandate is full employment and price stability, and I appreciate your efforts on behalf of our country to achieve those. My understanding is that critical data is collected by the Bureau of Labor Statistics to help formulate the indicators that you rely on, that we rely on to understand unemployment rates, CPI, and other inflation indicators. We are certainly hearing a lot about the impacts of DOGE on our workforce, and specifically about the elimination of many of those positions in BLS. And now we have a proposal in front of Congress to cut $56 million from that agency. Are you concerned about the ability of your team to get accurate data and about the ability to have reliable indicators to make good decisions upon?
I wouldn't say that I'm concerned about the data today, although clearly there has been a very mild degradation of the scope of the surveys and things like that. But I would say the direction of travel is something I'm concerned about, and that is measuring the U.S. economy carefully and well is a project that's been going on, and we're getting better at it for 100 years and more. And it's really important, not just for the Fed, but for Congress and for businesses, frankly, to know what really is going on in the economy. What's happening? Is growth high? Is it low? And all those sorts of things. So I think it's a smart investment to just continually try to get better at measurement of what's happening in the economy. And I don't like to see that, the kind of stories I'm reading and the idea being that the data is going to become more volatile and less reliable. That'll make it more difficult for the private sector and for you and for us, and I don't like to see that direction.
I agree. Thank you. I appreciate that it's not your role to comment on the advisability of specific policies, but given your critical role in ensuring price stability and reducing inflation, I have had conversations with, quite recently, just a week ago, with a C-suite executive of a major global retailer who informed me, because I asked, why aren't we seeing the impact of these tariffs and price data yet? And he said, it's coming in the third quarter, because it takes time for tariffs to work their way through a distribution chain. Often what you have on the shelf today may have been imported 2 or 3 months ago. Is that your understanding? Do you anticipate there may be impacts down the road?
Yeah, that's very much what I hear. I happened to meet with an unusually large number of business people in this last FOMC cycle, and that's a typical thing that they'll say, especially the retailers, that what's being sold now was in inventory in February, let's say, and it just isn't showing up yet. So we do expect to show up, tariff inflation to show up more, but I want to be honest, we really don't know how much of that's going to be passed through to the consumers. We just don't know, and we won't know until we see it. It could be lower than we expect. It could be higher. We have to wait and see, which is kind of what we're doing.
I appreciate the uncertainty. Another thing he told me that had me very concerned was that often they will increase prices on goods not subjected to tariffs to compensate for the very substantial losses they have to suffer with the increase of tariffs on relatively price elastic goods. So in other words, necessities will also tend to bear a higher price, even if they're not subjected to tariffs. Is that your understanding of the potential impacts?
You know, that very much is something that companies will tell you that they do. If they can't cover the losses on the thing that's being tariffed, they'll find other ways to do it. We actually don't have prominent examples of that yet, but that's certainly a possibility. And that did happen in the last tariff episode with washing machines and dryers.
Thank you, Mr. Chairman. And finally, you know, there's indications in the introduction of the report that the Fed is losing its ability, as we see interest rates getting closer and closer to the minimum threshold, the ability to stimulate this economy in times of recession. We haven't had a recession, or at least we haven't had an extended recession in a decade and a half. I am particularly concerned now as we are looking at debt that is being considered to be imposed on future generations by this particular bill. Could there be a combination of very high debt and very little room to move in monetary policy that could undermine our ability to respond to the next recession?
So we faced that issue quite a bit in the era of very low interest rates, but you know we're at higher levels of interest rates now, so there was significantly more room to cut than there was then.
Thank you.
Gentleman yields back. Gentleman from Wisconsin, Mr. Fitzgerald, you're recognized for 5 minutes.
Thank you, Chairman. Chairman Powell, thanks for being here today. Appreciate it. I want to go back to something we had some brief discussions about this in the past, but in September of 2024, with core inflation still being above target and the labor market was holding steady at the time, the Fed made a decision to cut rates by a full 0.5 percentage point. It kind of raised some serious questions as to whether or not the data truly supported such a move at that time, and I think some of us were surprised that it was a full 0.5%. So can you revisit that again, what the Fed was thinking at that time? Because it seems to be somewhat of an enigma now. It stands out as, you know, why was this done? Why was the 0.5% done at that point?
I'd be glad to. So first of all, actually the inflation and employment readings were very similar then to what they are now. They weren't terribly different, a tenth or two.
Right.
But the difference then was, you mentioned that the labor market was stable. It wasn't. The unemployment rate had actually gone up almost a full percentage point. I was very clear about this. We were very clear about it in real time too. The concern at that time was that there really hasn't been an experience, or hadn't been an experience in the modern era, in which the unemployment rate has gone up close to 1%. That hasn't been followed by much higher levels of unemployment and a recession. So we were looking at that and saying, and remember, at the point we're talking about, the federal funds rate was 5.3%, so definitely very restrictive level. We were the last of the big central banks to cut. So we wanted to make a statement that we were supportive of the labor market and not just inflation. We've been focusing on inflation. I was quite clear about this. So it was all about the labor market. Inflation was the same and unemployment was roughly the same, but it was the rate of change with the unemployment rate that raised a lot of concerns. And remember, we were being criticized for being late to cut. So we could have done 25. If we'd done 25 in July, we were criticized for not cutting in July. Instead, we cut 50 in September. And it seemed like the right thing to do. You know, and at the end of the day, we do what we think is the right thing when we think it's the right thing to do. We don't take into consideration political factors. If we start doing that, I don't know where that stops. Once you start considering elections and stuff like that, where does it stop? You know, so
and I don't want to insinuate that it had anything to do with the election itself, but there just seems to be some very similar numbers right now. And I'm wondering, and I don't bring this up because I want to kind of make a point about did the Fed do the right thing or not. I bring it up because it seems like everything's in place right now to kind of do the same thing, make the same move. I know this morning already, you've talked a little bit about where you were on inflation right now and kind of what you're watching, but is there any lesson there? I mean, are we in a position where it would be appropriate to do something as big as a 0.5% cut again?
Well, look, as I said earlier, if you just look at the basic data and don't look at the forecast, you would say that we would have continued cutting. The difference, of course, is at this time, all forecasters are expecting pretty soon that some significant inflation will show up from tariffs. Now, and we can't just ignore that. But we're not. We're just saying let's wait and see more. That's all we're doing. And if you will have noticed, a substantial majority of the committee has written down rate cuts in the remaining 4 meetings this year. So it's just a question of being prudent and careful. But at a time when the labor market is still strong, we don't see weakness in the labor market. If we did, that would change things. We're going to continue to adapt as the data adapt. But that is the difference between then and now. Then inflation was forecasted to continue to come down. Here it's forecasted to go up by all forecasters. So, and again, we're not overreacting to that. We're just saying, hey, as long as the economy's strong, we can take a little bit of a pause here. And that's what we're doing. And again, continue to adapt as the data comes in. If we see data that suggests that inflation's not going to produce big increases, that would matter. And if we saw the labor market weakening, that would matter too. But we don't see those things.
What about supply chain? In 2020, that was a big issue, obviously related to COVID. But I know myself and other members, when we're in our districts and we're specifically talking to light manufacturing, there's concerns about the supply chain. Is that part of the data package that you review when you make a decision about where we're headed in the future?
Very much so. I think that's one of the great, I won't call it a great thing, but one of the lessons to be taken from the last episode is supply chains really matter. We're watching that carefully. It's too soon to say really on that. We're not seeing it yet, but we could.
Gentleman's time has expired.
Thank you, Chairman. Yield back.
Thank you, Mr. Fitzgerald. The gentleman from New Jersey, Mr. Gottheimer, you're recognized for 5 minutes.
Thank you, Mr. Chairman. Chairman Powell, as a member of the Intelligence Committee, I'm deeply concerned about the threat of Iranian cyber attacks on our financial system as retaliation for our strikes on their nuclear facilities. In its cybersecurity report last year, the Fed acknowledged that critical infrastructure, including financial services, is at risk with rising geopolitical tensions. Iran has a history of targeting American infrastructure companies and financial institutions and banks, which could obviously threaten and cause economic damage. What actions is the Fed taking now to monitor and defend against Iranian or proxy cyber threats targeting our country's financial institutions?
So we're in touch with the other regulators and the parts of the government that work on cyber, as you know, and we're in touch with the banks to say, for people to be on the alert for things like that to happen, and also we're on the alert because we're a target as well. So you're right to raise it. It's a big issue, and
do you feel like you have the resources right now to be prepared for that?
Yes, I mean I think we do. We spend a lot, and the government generally spends a lot on these things, and but you can never ever be comfortable in this area because the bad guys are always getting better. So we need to keep to get better.
Thank you, Chairman. Switching gears, the president and members of his administration have recently called you out, various name calling for certain decisions you've made. I know that some people worry that the president's bullying will impact your decision making. I know you work together, and I know that and respect, obviously, your independence greatly. Anything you want to add and give you a chance to reiterate your independence to the American people?
Yeah, I would just say we're focused on one thing, and that is we want to deliver a good economy for the benefit of the American people. That's it. And anything else is kind of a distraction. I don't mean to refer to any particular thing, but we stay focused on that task all the time. We always do what we think is the right thing to do. And, we live with the consequences. And I don't know how else to do the job.